Hi, everyone, and welcome. Thank you for joining us today. My name is Alok Gupta, and I lead marketing and strategy here at Sandro Wealth. We are glad that you could join us for what should be an insightful discussion covering two distinct but related perspectives: wealth management and business valuation. In today's session, which is specifically designed for business owners, we'll discuss a few topics, including the factors that influence business value, how to assess whether the value of the business aligns with your future financial goals, and why is it so important to build the right team of advisors to support your exit planning process? I'm joined today by Garrett D'Alessandro, CEO of Sandro Wealth Management, and Shina Culberson, President of Quist Valuation. If I can please ask both of my panelists to introduce themselves, and then we can get started with our discussion. Garrett, can I please start with you?
Thank you, Alok, and hello, everyone. I'm the CEO of Sandro Wealth, and I've been working with high net worth individuals for 35 years, alongside their trusted financial advisors, CPAs, trust and estate attorneys, and various business subject matter experts like Shina. I am and was a business owner, having done this a couple times, and I do understand the consequences of doing it right and also the consequences of not doing it perfectly. So I come at this from a real practical experience. And today, Shine and I are going to give you good ideas, if you're a business owner, on the better ways to think about maximizing the outcome of the sale of your business.
Thanks, Garrett. Shina, could you please introduce yourself?
Yes, thanks for having me. It's a real pleasure. So I'm Shina Culberson. I'm the president of Quist Valuation. And Quist Valuation is a business valuation firm. We're located in Colorado. And I like to say the only thing that we do all day, every day is work with business owners and helping them understand the value of their companies and what's driving that value. So we've been around since 1984, over 40 years of history. We are ourselves on our third ownership transition. I'm the third owner of Quist, so I like to think that I intimately understand where our business owner clients sit when they start to think about what is going to be the next phase, the next step with their business. What are they going to do with their business? How are they going to exit from their business? We have lived that ourselves institutionally within our organization. But we do about 200 valuations a year. Some of our clients have been with us for over 20 years, where we're valuing them every year. And it's a real honor to work with clients like that. So I'm really thankful to be with you today.
Great. Thank you both. Okay, let's get started. Garrett, let me come to you with the first question. When we talk about the drivers of business value, what should business owners be keeping in mind while they're in the building phase of their business?
Yeah, so they should think about the sales proceeds, and in particular, the sales proceeds after sales expenses, taxes, and other reductions from the proceeds. So that's the first thing that they should give a priority to. And usually those things are impacted importantly by how well they plan in advance. And we help advisors and the business owners run multiple scenarios to determine what the best structure of the sale is, what the proceeds after each of those different scenarios should be, and they vary depending upon the different structures and outcomes. So we prefer to work with business owners and their advisors early in the process.
Sticking to the same topic, China, of what drives value, coming to you with a different question. What are business owners in your mind doing, and given your experience of doing so many valuations, what are they doing or not doing that affects value down the road when it's time for them to actually sell the business and transition?
Well, I think it's a great question. I think many business owners think as valuation as a one-time event right before they go and sell their companies. But as Garrett mentioned, Valuation can really be used as a planning tool for business owners. And in my experience, the earlier the business owner can get a valuation and understand the drivers of value of their companies, the better they're going to set themselves up for success and growth over time. So when we think about business value, I think business owners automatically understand this idea of growing revenue and growing profitability in their business to increase value. But the other sort of missed factor is this idea of de-risking a business. And you can have two businesses that are the same revenue, the same profitability, but the one that's also focused on de-risking their business, they also can grow their value exponentially without necessarily having to, do this double-digit growth on revenue or profitability. So what do I mean by de-risking? I tend to think about business value in about 5 different categories. So one is like your market position. Like, what are the barriers to entry? How do you have a market distinction in your industry amongst your peers? We talk about that as being your sort of market value, right? Your market external value. Then there is organizational value, and that's your systems and processes. So think about, how do I document what the business does every day? How can I create a repeatable throughput for my services and my products that isn't personnel dependent? So those are your documenting your systems and processes. That's what we call organizational value. Then there's employee value. I think people understand that human capital, like having good people on your team. And then there's customer value. How do you, connect to your customers, have repeat customers, make sure they're satisfied with your services, and grow that customer value. And then there's financial management. So that's just good record keeping. So in those categories that I described, you can see businesses can look at those categories of business drivers, think about, how do I de-risk the business by thinking about those categories? They have nothing to do with necessarily driving revenue or profitability, but it's, how do I create repeatable processes? How do I create a leadership team and an employee team where they're all moving in the same direction, they have the same goals and objectives, and they have really clear understanding of what their roles are? How do I create an organization that has a very distinguished brand? And then most importantly, how do I have good financial management around having that predictability in what to expect from our future cash flow? So those are the categories that we think about from a valuation perspective. But from just stepping back and sort of rethinking about this again, the way that you take two very similar companies but continue to grow value is, one could be de-risking the business, and one could be growing top line revenue profitability. If you can do both together, that is where you find the magic and where exponential growth and value growth can really excel. So sorry, look, I think that was a long-winded
No.
answer to your question. There's a lot there to unpack. So let me know if you have any follow-up questions from that.
No, I think this is exactly the kind of information that the business owners who are attending this discussion need to understand. And thank you for really taking this whole business of value, of what drives value, into two separate categories. I think, and correct me if I'm wrong on this one, China, but the de-risking piece is something which many business owners might be overlooking at this point and concentrating more on. If I were to increase my top line growth, obviously that's going to increase value. But maybe de-risking is something which should also be at the same level creating the systems and documenting processes, etc. What, in
Yeah,
your experience, do you think that's what you have seen, that people focus more on the profitability side, but not so much on the de-risking side? They should be doing both.
I think so. Well, I just think about myself and probably Garrett, you too, as a business owner and an entrepreneur. I mean, we become business owners and entrepreneurs because we probably love the deal. We love to make a sale, or we really love to invent new products and services, right? This,
Right.
what I would say is the less glamorous side of business is creating a system and processing and documenting it. Ugh, that doesn't sound like a lot of fun.
Right.
Or, having to re describe roles and responsibilities. Hey, Garrett, you said you're going to do this every day, and this is your role, and this is your responsibility, and this is how we're going to reward you. Well, and this is, Shina, this is my role, this is my responsibility, this is how I'm going to be rewarded for what I'm doing. And to continuously update that and iterate on that, that's not really the glamorous part from an entrepreneur's mindset, probably. But it's really important for scaling a business when the entrepreneur and the business owner want to make their business less dependent on them as individuals. So all that sort of less glamorous foundational work is really important when setting up business. And that is the key, I think, to de-risking. If you do a little bit along the way, it's really beneficial as a company scales.
Garrett, any thoughts on that? I think at Sandro, we actually take that very seriously, creating repeatable processes, documenting everything, even though we are very customized in the way we serve high net worth clients, but we still have, we give a lot of attention to that part of the business.
So what I like about the comprehensive approach that Shina takes is if Shina or I said, would you do that work if you got $4 million more in sale proceeds? You wouldn't be asking, well, why do I have to do that? Or boy, that sounds boring. And where that fits in is when the owner says, I take $1 million out of the business, and that's my lifestyle requirement. How do I replace that $1 million? Often, or I would say to some percent of the deals, after you sell the business, after taxes and expenses, with an investment portfolio, let's call it a balanced investment portfolio, you might end up with $800,000, not 1 million. But if following the 5 protocols that Shina described would change the outcome of the proceeds, and instead of only getting 800,000 from your portfolio, you can get 1.1 million from your portfolio, you'd be really paying attention to doing those 5 practices and protocols. And that's really how we work with Shina and the business owner and the advisor. We take a range of potential sale values based on the valuation work that Shina does, and where you fit within that valuation spectrum, we then apply taxes and expenses, and then we build different portfolios: a conservative portfolio, a balanced portfolio, a growth portfolio. You have more bonds or you have more private equity. And by going through different sale proceeds and different portfolios, we can give you the number that you want, which is, I used to make $1 million out of my business. After all of this is done, am I going to have $1 million in perpetuity from the portfolio? And we can only do that by the modeling that I'm referring to. And many times, just as Shina's articulated, doing those 5 protocols in advance or along the way, you're going to hear similarly from me, doing tax planning in advance, doing long short tax harvesting in advance, structuring different trusts can change the amount that you net and the amount that you get in cash flow. So we prefer to work with the business owner, say a year or 2 before, on understanding that portfolio modeling, showing you the different cash flows that come out of that. And then when you're working with the sale process, you'll have a sale number and how that aligns and how that connects specifically to your annual income post-sale.
So that's a really important topic, right, Garrett, which you are touching upon, which is what we should get into now. in some detail, which is you know the drivers of value for a business, as we talked about, and Garrett, you started touching upon the fact that knowing the drivers helps you because ultimately when you transition and exit the business, the value that you get, does that really enough to fund the lifestyle that you're expecting post transition, post exit? And you started touching upon the fact that a sale amount is one, but then you also need to factor in the expenses, the taxes. Is there something I was wondering if Garrett, you could dig a little bit deeper into the tax portion, the different strategies that at Sandro we deploy. Tax carrying the tax losses forward. There are certain strategies that you have specifically developed for business owners. Can you dig a little bit deeper into those aspects?
Typically, when you sell a business, you have a capital gain tax versus an ordinary income tax. And capital gains, let's say 23% plus the state. Those capital gains would or could be mitigated if a year or two before you sell the business, you do tax loss harvesting strategies. So you have a $5 million portfolio, and let's say 20% of that portfolio, which would be $1 million in capital losses, are put in the bank a year or two in advance. And if you do that 2 years before, you have $2 million. And then in the year of sale, you can invest part of the sale proceeds to generate tax losses. So you might mitigate $2 to $4 million of capital gains through the use of these long short tax loss harvesting strategies that we and many people who sell their business take the opportunity to deploy in advance of the actual sale of the business.
And that can have a big impact on the funds that are ultimately available to the business owner post transition. That's a really good explanation. Thanks for that, Garrett. Shina, let me come to you as a follow-up on the same topic. When you think about business owners, what's the fuller picture that owners are usually missing in your experience, especially when it comes to things like the valuation number is a number, but maybe not the ultimate number, and also the deal structure. I've heard you talk about the fact that the deal structure is also as important as the valuation number itself. So could you just give us some more details on those aspects?
Yeah, it's a really great topic. I mean, I think we heard from Garrett's answer. I think one of the things is planning for an exit and maximizing your proceeds from a sale. You really can't start too early in your tax planning strategies, right? So Garrett explained a strategy that might start 2 years ahead of a sale. I've personally been in situation where business owners have called me and said, okay, I've got a couple LOIs, I've got a data room set up, but I'm just going to put it to the side. And then I want to work with you on valuation to do tax mitigation strategies, transfer ownership to trust, et cetera, et cetera. And then I'll open up the data room and we're going to close a sale. And at that point, it's just a little, I mean, there's some things that still can be done, but there's no way a business owner can really leverage and maximize all the things that are available to them to put in place those tax mitigation strategies ahead of a sale. So the number one thing I say is it's never too early to start talking about what an exit looks like with all of the advisory team members that would be accessible to you. So that's your wealth manager, your wealth advisor, your CPA, your attorney, your tax attorney, your valuation expert. Bring us all along to the table with you to get an understanding of what the timing might look like, what the certain challenges are, and help us as professionals be of service to you to really help meet your goals and objectives. I think no one person can know all the little intricacies of doing what we do. So I think bringing like-minded individuals who are in service to the business owner to the table early is really key. And to your point, Alok, you mentioned, the headline number from a sale may be misleading. If you haven't done all those tax mitigation strategies, the net proceeds after taxes could look a lot different than that headline number that you're expecting. So understanding and planning for this early is of great benefit, and the business owner won't be caught unaware or surprised that all of a sudden their wealth gap actually hasn't closed because their purchase proceeds or their sale proceeds didn't actually match that wealth gap that needed to be closed. The other factor that you alluded to, although that can sometimes be missed, is the price. We always say in the exit planning world, price is a function of deal structure. So what does that mean? So deal structure can look like cash up front in hand, but it also could be, it look like an earnout or some proceeds that get paid out over time, sometimes over years. And
Yeah.
sometimes those payouts are tied to some sort of performance of the business after you've sold it that you don't have any control over, or you may not have as much control over as you did when you were the primary owner driver of that business. And so that also can really change the outlook of what the proceeds look like after a sell, depending upon that deal structure. How much is cash? How much is in an earnout? Even, deals that I see that are somewhat friendly seem to more often than not have some sort of delayed sort of payout component to it, where the seller is sort of financing a little bit of that transaction for the buyer. And so again, that could just make the expectations of how the business owner is closing that wealth gap for themselves look a little different than maybe what they thought when they go, oh, I'm just going to sell my business for this headline dollar amount. May not come right away, or may not even come at all if some of those performance attributes don't actually come to fruition for the business owner after they've sold the company.
Yeah, very well put, Shina. And this actually, what you're mentioning, the fact that it's the headline number, but the deal structure, and the deal structure is complex. And you started touching upon the topic that I wanted us to discuss next and ask both a few questions, was the team structure. And you just mentioned the deal structure itself is complex. And whether you go for whatever options that you have in front of you, you do need a team to understand what drives value, what is the valuation, what kind of an estate plan would be best for you, what are the tax mitigation strategies, what is the investment management portfolio structure that you should be putting in place. These are all connected. So you started talking about this, Shina, in your answer previously, but I wanted to just drill down a little bit more. This whole idea of creating the right team, which I have heard from you and obviously from Garrett many times, that business owners need to start building a team. I'm just going to touch upon a couple of things that I have heard. That one is that decisions in one area can directly impact decisions in other areas. Valuation, tax strategy, deal structure, estate plan. I just mentioned those things. These are all very, very, it's a complex business, valuing and selling a business, and you need the right team in place, and they should be all present throughout the process. And starting early gives business owners the time to implement and not just react under the fact that the team should not be working in silos. Any of these topics, Shana, you want to pick on? I wanted to stay with you and then come to you, Garrett, with your experiences. Any of these themes sound to you as being more important? They're all important. Other things that you have found in your experience, business owners are doing well or not doing well in terms of creating teams?
Yeah, I mean, I think to your point, absolutely. So your advisor should not be working in silos.
Yeah.
There should be transparency amongst your advisors about what your goals as a business owner are and your objectives. And I'll just speak for myself. From a valuation perspective, it's very common that we are maybe brought in early into the process to get an idea of what business value looks like, maybe a range of value. That's just enough to get the business owner and their advisors some sort of direction about, okay, if the sale of the company was in this range provided by Shina and her team, what would we do in terms of strategy around, again, wealth transfer planning? Do we need to secure maybe key employees within the organization? How do we incentivize them through a potential transaction? What does that mean, again, for ultimate proceeds that would come to the primary business owner and seller? Just so we often will start off with sort of that initial range of value, and then the team will work together, go off, do some planning, maybe put some trust in place, etc. Then come back to us and go, okay, now we have a very different specific need for valuation. We'll do another valuation to maybe hit that very specific need, like setting up trust and actually gifting interest in the company. And then the team will go back together, they'll do more strategy, and then as the company then goes to market, will be brought in and do another specific sort of valuation to go to market, based on who is a real potential buyer for the company. But all that happens over time. So again, my key takeaway is just give yourself enough time to put together the planning and the strategy, and leverage folks like yourselves who can really help direct and make sure all the boxes are ticked and that the business owner is set up for success, because it does take time.
Mm-hmm.
Yeah.
Got it. Garrett, coming to you from the wealth side, how can a business owner be well prepared?
So maximizing the sale proceeds at the headline is important. Shina articulated the specifics there in terms of structure. What we care about is making certain that when that good offer that matches the valuation work is received, that the owner can connect that proceed amount after the taxes and expenses that we talked about with the strategic allocation, i.e. what their portfolio is going to be represented by. And many business owners, a majority of them, say, I'll deal with that when the check clears, or I'll deal with that later. And while that's certainly one approach, it often causes a lot of uncertainty in the mind of the owner as to whether or not that sale price is good and will accomplish their lifestyle goals. So we do prefer that a year or two in advance, when the nerves are calm and there's no deal on the line and the stresses of selling your business aren't at a high level, that we work with the business owner and their advisor and their tax professionals and arrive in advance with one or two, or finalize on one or two strategic asset allocations. We often see the business owner say, I know risk. I've run my own business for years, so I'm a big risk taker. And then I say, well, when you're in control of the business, you don't perceive those risks to be the same as if the stock market's in control and you're seeing your $32 million swing around by $3 million or $5 million. That risk lands on each person in their own way. So we want to go through that simulation, as I said, a year in advance or 6 months in advance, not in the moment when you're trying to figure out, should I take this offer, or should I take this structure of the offer? We talked about working in advance on tax mitigation strategies. A good example, I'm not intending to get ahead of myself, but in January of 2027, some phenomenal new tax opportunities. Opportunity zone investing are going to apply to business owners who sell their business. And if I just gave you a preview and said, how would you like to not pay any tax on 100% of the capital gain on your business? You'd be interested in hearing about that opportunity zone. And not only not paying any tax, not paying any tax for 5 years. So lots of things to do in advance. And you can do those with a clear mind, not in the middle of the deal. So we generally like to gain the trust and confidence of the business owner going through all of that portfolio work well in advance, so we understand what the plan of action will be, rather than I'll let the check clear, I'm going to stick it in the bank and let it sit there earning 2 or 3%. Because I can tell you, once it goes there, it usually stays there, and 3% will not generally get the business owner, him or her, the lifestyle that they want. And then they'll start eating into principal, which will cause other frustrations.
Got it. Yeah, preparation is key. Thank you for that, Garrett. So business owners who are listening to this discussion, right? We've talked about the drivers of value, what drives value, understanding and making sure that you understand once the business is transitioned, the value is enough to fund lifestyle post transition. And then also the fact that you need a team, you need preparation so that you can maximize the value at the time of transition. So I want to ask you both the same question and keep it and make it very practical for those who are listening to this discussion. Shina, let me start with you. What is the first move for someone listening for them to make, or the first couple of moves that they should be thinking about when we finish the discussion and they're thinking about what are my next steps?
Of course, I'm going to say get a valuation. Even if you're not thinking about selling, I would think about getting a valuation as a way, as a planning tool, as a way to really understand the what factors are driving your company value higher, which factors um, are roadblocks to your company's value. So you can really use valuation as a planning tool to identify those value gaps within your organization. Know that some recommendations to improve value just take time. So understanding those early will afford you the time to make some real improvements, not just sort of superficial improvements, but real deep institutional improvements for your organization. I think the top sort of levers that I think any business owner can take away from this discussion would be, ironically, how do you make yourself unimportant in your business? Meaning, how do you reduce that key man risk in your organization to yourself? So, go take a vacation, see how your team does, see how the organization runs without you. I really encourage business owners, take a vacation and try to not check in every day and really see where the gaps are. It's summertime, we can all do that, right? We all want to do that. The other thing is really understand your customer satisfaction. So I think anecdotally, we all understand how satisfied our customers are, but I think if you have a real systems to making sure and getting your input from your customers about how you can make the delivery of your product or service even better, you're getting some insight that's really free to you, because these are already your customers who've decided that they want to do business with you. So I would really leverage your relationship with them to gain some greater insight. And then lastly, I sound like a broken record here, but this is just so key, is to make sure you have your organization's systems and processes documented. I've seen a number of businesses who want to go to market, and all of a sudden they're working with their business advisor and they're like, great, we're going to set up a data room and we want you to put all your contracts, all your manuals, all your how-tos and knowledge base into this database. And only to find that business owners don't have it, and they have to try to recreate it or just create it for the first time then, and it just takes so much time to do that. And so if you start now and delegate it amongst team members, it will be just a lot less painful because you have to have that done before you go to market anyways. So those are my 3 key sort of takeaways. Go on vacation, talk to your clients, and start documenting how to, so that you can go on vacation.
Yeah, and get a valuation done.
And get a valuation.
Garrett, what do you think of practical tips to people who are listening to this discussion, besides calling you and Shina and to setting up a discussion? What should they be thinking about as their first next move?
Finding really excellent investment and wealth management talent is not easy, and it takes time, and you have to gain trust and confidence. And Shina has mentioned this many times. It takes a relationship, and building a relationship with an investment expert doesn't happen 3 months before you're about to sell the business. So invest in finding that highly capable, competent investment portfolio management firm and team. Number one. Number two, understand your options. There are many ways that you can mitigate capital gains taxes or reduce the expenses, or put both of those to work and end up with a larger after-tax proceeds. And then the third is know the relationship between what you sell the business for after expense and taxes and what lifestyle you can live in a perpetual equilibrium, right? So that reduces a lot of uncertainty. To some extent, the anxiety is, should I sell it for this amount, or should I take this amount, or should I bear that expense, or what should I do here? Always connected to the human element of, I want to take care of myself, my family, and the next generation. What that means to you. Is that $1 million a year? Is that $500,000 a year? We work with you, and we absolutely can give you very high confidence that will take all of that away from you during that 3 or 6, 9-month window when you're selling the business.
Great discussion. And like you have both mentioned, that, the big takeaway for me here is that value is built intentionally. Knowing where you stand early creates real choices, more choices. And the plan really has to go beyond the transaction itself. You have to build a team, and all of this takes time. I think, thank you very much to both of you for a really great discussion, for a thoughtful discussion today. And also thank you to everyone who's joined us and spent the last 35, 40 minutes with us. I hope this discussion was valuable to you. As Garrett has mentioned, give us a call and talk to us. If you'd like to continue the conversation, learn more about Sandro or about Quist, you can go to our websites and check us out, and also just give us a call and contact us. You have the details in the registration page that you have filled out to come for the webinar. But yeah, thanks again. Until next time, and thank you both, Garrett and Shina, for this wonderful discussion. Until next time, thank you and take care.
Thank you.